Check, please.
Hey, welcome back to Everything Money. Paul's not here at the moment, but what we're going to do is a blind stock analysis. Paul said all the time, we've tried to teach you on this channel that you can cover up the name. Forget about what the company does. Forget about their name and what you've heard about them. Let's look at the financial numbers and make an investing decision on the actual numbers. Like if you're going to buy a business, what do they make? What do they do? What kind of shares do they have outstanding? What kind of debt do they have? We'll do all this and more through our 8-pillar process in this blind stock analysis. Let's try and trick Paul on this one. Okay, Paul, I already did the intro for this, so we're going to spin around and start analyzing this company. Like I sort of mentioned the idea of like you're a true business person and this is a business.
All right, guys. So $112 billion market cap, revenue of $30 billion.
How does it hit you already, Net?
All right. I mean, PE 27, 5-year PE of 35, so it's growing its profit. Dividend yield, oh, I'm surprised by this. Half the money in dividends, okay. Wow, 5-year return on invested capital, suck me sideways, call me Betty. Recent drop. 126 with the high, 52-week low is at 93. Okay.
Shall we, initial thoughts on the first scan here?
I mean, if this is a growing company, this could go very well. The thing I'm confused about is this is a pretty big dividend for a company that might be growing. Something tells me it's a stagnant growth business, even though that profit has grown in the last 5 years. Or maybe they had a big write-off 1 year or something. I don't know.
Okay, let's keep going.
Okay. So 13 billion to 27, doubled in size in the last 10 years. Don't know how much that's from acquisitions. Okay, look at this. This is the big drop. 2 years ago, they had a big drop. 2020. Because of probably COVID.
Yeah, so the revenue went from 13 billion to 27 billion in the last decade. Their net income went from 1.3 billion, and then it went up to like, oh wow, Paul, look at that. Then 2 billion, 2, 4, and then all the way down to less than 1, and then up to 4.
Well, this is COVID year. This could be this is a COVID year. Now the revenue didn't fall a ton though. But I'm trying to look for other write-offs. I'm not really right here. 278 million. It's not a huge write-off.
Any guesses on the sector with that?
Oh God, I got nothing here.
With that big smash in net income.
Yeah, but the revenue didn't drop like half or something. You know what I mean? It's a sector.
We can keep going. I can keep.
Yeah, let's keep going. This is good. This is a good one.
Okay.
I'm stumped.
Right, here's the third.
Shares outstanding. Ooh, that's going down big time. Huh.
You like shares going down?
Yeah, look at their dividend, up 5 times since 10 years ago. 5-time higher dividend. Okay, next screen.
Okay.
All right, total current assets, 9.8 billion. Okay. Can I see the cash flow statement first, actually?
Sure.
So cash flow is up a lot in the last 10 years. A couple of drops here and there. 2014, 2020, obviously from what it's called. Boy, a $10 billion cash flow here. What did they do? Change in working capital. That was a big jump. Was there a, can you show me the acquisitions, dispositions here? Okay. So they got 600 million here. All right. Not a lot of, interesting. Oh my God. This one's, okay, good. Keep going. Give me back to the, the average cash flow was $4 billion. Okay.
Okay.
And then what's the long-term liabilities? Show me the balance sheet.
Okay.
7 times debt, 7 times 5-year free cash flow for the debt, which is a little high. Okay. All right. And the $4 billion, okay, it's a $4 billion average and then $120 billion, $112 billion, that's 27 times free cash flow. I am stumped completely.
Stumped on this one? No sector yet? Or
I don't even have a sector. The cash on hand was like almost 10 billion, total current liabilities of 8 billion. So they're able to cover that.
Okay, Paul, let's pull up the 8 pillars and you can give us all of your thoughts about this company. Go ahead.
All right, so expensive, and a little bit more debt. Buying back shares, though, revenue's up, cash flow's up, net income's up. And I like the fact they had a lot of growth in revenue without many acquisitions. Damn.
So are you liking this company?
No, it's too expensive. I mean, the growth isn't there to justify these high prices.
And would the sector matter if it's, I mean, the numbers are probably telling you the sector, but like, this obviously isn't like a software company or something. But what about timing of the company? Could you say this is an older company, a younger hype company? What do you think?
Is this a car company?
It's not.
Man. This is really, 18%. Man. 14% profit margin, but only 29% gross margin. Is this Home Depot? No, it's not Home Depot. Maybe it is Home Depot. This is Home Depot or Lowe's.
At any point, would you have invested in this company?
Well, what do you mean at any point?
10 years, over the past 10 years.
How would I know? I don't know what the values were versus, I don't know what the price for the value was.
And why haven't you looked at the stock price yet?
Because it's irrelevant.
Tell me why.
Because all I care about is the price of the entire company. The stock price is manipulation between the value of the company and the number of shares they have outstanding, which they can manipulate every quarter.
You're telling me that if the stock price is $4,000 a share or 40 cents a share, theoretically it doesn't matter because
not theoretically, it does not. What matters is this: I can make every stock price 116 billion. Just have one share outstanding. I can make it $1 by having 116 billion shares outstanding.
So when it's all said and done, Paul, why don't we look at the stock analyzer tool as a part of our software? You can have this tool and more. We'll tell you later in the video. Walk us through a business person's thought process on this, Paul.
All right. Revenue growth. Let's do 357.
357. Okay. Profit margin seems pretty consistent over a decade.
12 and a half, 13. Actually, go 11 and a half, 12 and a half, 13 and a half.
Okay.
Because you go any slower.
Okay.
Cash flow margin, do 13 and a half.
13.5. Yeah.
Sorry, do 13. Just hit shift tab.
I know I'm stupid.
14.5.
14.5.
And 16.
16. Okay, thank you.
Hit tab again. There you go. PE. 13, 15, 17 for both PE and price of free cash flow.
So why do you want such a difference in PE right now? This is an established company.
I don't think these revenue growth numbers aren't like blowing me out of the water. I'm not like, yeah, this is incredible. I'm like, okay, it's pretty good. I still badly just want to wipe that.
No, don't do it. It's not for us. It's for our viewers.
You're right.
Okay, now what we're going to do, folks, is we're going to hit the analyze button and see what we need to be paying for this stock today to get a 12.5% return for every year for the next 10 years. And if this is too frothy or too confusing, you can just put your money in an ETF and not do any of this stuff. But this is the price you pay to take a little bit of risk.
Hit the button.
All right, now face this way, Paul.
I'm facing.
Okay.
Is all good over here?
It's all good.
Anything?
No, go ahead, Paul. Okay, so the current stock price of this company is $97.80, and our assumptions are showing us what, Paul?
It's got to fall in half, basically. A low of high 30s, high 40s, low 50s, and then, yeah, bottom line is it's got to be around $50. So it's got to fall in half from here.
I can't imagine you know what this company is.
I have no clue.
What if I told you that millions of people stand in line to get this product?
Is this Apple?
On a daily basis? No, sometimes twice a day, Paul. They'll stand in line on their phones in the airports. They're standing there just waiting.
Is it Match.com?
Here we go.
Oh my gosh.
It's Starbucks.
Starbucks.
What do you think?
Wow.
Your thoughts?
I was surprised about the gross margin. I thought the gross margin at Starbucks would be higher than 28%.
Higher.
Yeah, because I thought, it's liquid. And
Yeah,
it's like
they're
$8
turning
coffee.
water-
I'm like, it's like, what are we talking about here?
They're turning water into brown water.
Yeah. It's like biblical proportions here. I mean, yeah. Wow, Starbucks.
Are you a current investor in Starbucks
I'm
today?
not.
And are these numbers fondling you enough to get into it?
No, I want to wait for it to fall in half.
Like always.
Yeah, like always.
An interesting concept, though, is really not letting... So you obviously didn't let the hype of Starbucks, the popularity, stray you from saying, I'm not investing in this.
I don't care how popular it is. That'll be reflected in its growth numbers. It'll be reflected in its stock price eventually. If the growth is huge, it's very popular. But if everybody in the world used it, what's the growth potential?
Yeah.
There's no growth potential. If everybody in the world used it, it cannot grow anymore.
And that's a concept I have a hard time. Maybe you at home I have a hard time comprehending this, that like smaller companies have way more growth potential than these huge companies. At some point, you can only sell so many cars and sell so many cups of coffee before you've equilibrated. So
if I'm in a market and I put a 100,000 unit apartment building up, it's not going to be filled.
Or sold to someone else, maybe.
All of a sudden, it's 100,000 units put up in one building. What's going to happen? The market's going to go, okay, well, now there's more units up there. Let's just drop the price. That's just the way it works, guys.
That's a blind stock analysis with Paul. If you're drawn to these numbers, looking at the financials, and this interests you, you can have our software. Go to everythingmoney.com for all the tools we use in this video, the stock analyzer tool, all the financials in the palm of your hand on a phone app. You can have our community of over 6,000 people. You get exclusive videos from our team every single day and access to us. You can have all this at everythingmoney.com or patreon.com/everythingmoney. It's currently $1 a day, and it goes up every single month. So get in now, and you can have access to these. Go ahead, Paul.
But when you pay the $1 a day today, that is your locked-in level forever.
That's right. It doesn't go up for you.
If the price triples in a year, you're still paying your same level.
And you'll have access to the financials you've probably always been wondering about, and it can certainly help you make better financial decisions. That's your take on Starbucks. See you next video. Fondle the thumbs up.